Let me paint you two pictures. Person A graduates college, lands their first real job, and starts investing $500 a month into a simple S&P 500 index fund. They never touch it, they never think about it. 40 years later, they're sitting on roughly $3 million, and they spent maybe 3 hours a year managing it. Person B does something different. They scrape together a down payment, buy a rental property, deal with tenants, fix leaky pipes, pay a property manager, handle vacancies, and refinance twice. 40 years later, they own several properties, have strong cash flow, and their net worth is also in the millions. But they worked a lot harder to get there. So here's the question everyone wants answered. Which path is better? Index funds or real estate? The honest answer is, it depends. But today I'm going to give you the full picture so you can decide which one, or which combination, belongs in your financial future. Before we get into the debate, let's make sure we're on the same page about what we're actually comparing. Index funds are a type of investment that tracks a market index, like the S&P 500, which represents 500 of the largest companies in the United States. When you buy into an index fund, you're buying a tiny slice of all those companies at once. You get instant diversification, and your returns mirror the market's performance. Historically, the S&P 500 has returned an average of about 10% annually before inflation, roughly 7% after adjusting for it. The beauty of index funds is their simplicity. You open a brokerage account, deposit money, and you're done. Low fees, no landlord duties, no midnight maintenance calls. Real estate investing, on the other hand, means buying physical property, either to rent out for income, to flip for profit, or to hold as a long-term appreciating asset. Your returns come from two sources: rental income, cash flow, and property appreciation over time. Historically, U.S. real estate has appreciated at around 3 to 5% annually, but when you factor in rental income, leverage, and tax advantages, the total picture gets much more interesting. So, on paper, index funds look like the clear winner in pure return terms, but real estate has a few tricks up its sleeve that change the math significantly. Let me make the strongest case possible for index funds first, because honestly, for most people, they are the single most powerful wealth-building tool available. Number 1, simplicity. You don't need to research neighborhoods, screen tenants, negotiate contracts, or understand zoning laws. You buy, you hold. Time does the work. Number 2, liquidity. This is massive and often overlooked. If you need money in an emergency, you can sell your index fund position in minutes. Try doing that with a rental property. You're looking at months, sometimes longer, and thousands of dollars in transaction costs. Number 3, low barrier to entry. You can start investing in an index fund with as little as $1. Real estate typically requires a 20% down payment, which on a $300,000 property is $60,000 just to get in the door. Number 4, true diversification. One index fund gives you exposure to hundreds or thousands of companies across dozens of industries and geographies. One rental property is one asset in one city on one street. Number 5, tax advantages. When you invest through a 401k or Roth IRA, your money grows either tax-deferred or completely tax-free. Over decades, the compounding effect of tax-sheltered growth is extraordinary. And the historical returns speak for themselves. Someone who invested $10,000 in an S&P 500 index fund in 1990 would have over $200,000 today, doing absolutely nothing. The market rewards patience. Now, let's talk about why real estate has made more millionaires than arguably any other asset class in history. Number 1, leverage. This is the single biggest advantage real estate has over index funds, and it changes everything. When you put 20% down on a property, you control 100% of the asset. Your $60,000 down payment controls a $300,000 investment. If that property appreciates 10%, you haven't made 10% on your money. You've made 50% return on your actual cash invested. That's the power of leverage. You simply cannot do this with index funds without taking on serious risk. Number 2, cash flow. A well-purchased rental property puts money in your pocket every single month. That cash flow is real, tangible, and can cover your mortgage, your bills, or fund your next investment. Index funds generate dividends, but they're typically much smaller and far less predictable as income. Number 3. Tax benefits. The U.S. tax code is extraordinarily generous to real estate investors. You can deduct mortgage interest, property taxes, insurance, maintenance, and even depreciation, which lets you report a loss on paper even when you're making money in reality. And when you sell, the 1031 exchange allows you to roll your gains into another property and defer capital gains taxes indefinitely. These advantages are significant and compound over time. Number 4. Inflation hedge. Real estate is one of the best inflation hedges available. When inflation goes up, rents go up, and property values tend to follow. Your fixed-rate mortgage payment stays the same while your rental income rises, meaning your cash flow improves automatically with inflation. Number 5. Tangibility and control. You can see your investment. You can improve it. You can paint it, renovate it, add a unit, attract better tenants. You are the decision maker. With an index fund, you're along for the ride, completely at the mercy of market forces you can't control. Now, both of these have real risks that the cheerleaders on either side often underplay, let's be honest. Index fund risks. Markets crash. The 2008 financial crisis saw the S&P 500 drop nearly 57%. If you panic sell at the bottom, as many people do, you lock in catastrophic losses. The biggest risk with index funds is behavioral. You, the human investor. People buy high, sell low, and undermine their own returns constantly. The market's 10% historical average means nothing if you bail during every correction. Also, index funds give you no income during your working years unless you're selling shares. You're entirely dependent on appreciation. Real estate risks? Real estate is illiquid, management-intensive, and far more complex than most new investors realize. Bad tenants can cost you thousands in damages and legal fees. A vacant property is cash negative every month. Markets can stagnate or decline. Just ask anyone who bought in Detroit or certain markets post-2008. There's also concentration risk. If you have most of your net worth in 1 or 2 properties in one city, and that local market crashes, you're devastated. There's no diversification there. And then there's the time cost, the true hidden cost of real estate. Being a landlord is work. Even with a property manager taking 8 to 10% of your rent, you're still involved. That time has value. So where does that leave us? Let me give you some practical guidance. Choose index funds if you're just starting out and don't have significant capital, you want a hands-off, low-maintenance investment, you highly value liquidity and flexibility, you're investing through tax-advantaged accounts like a 401k or IRA. You don't have the temperament, time, or interest for active management. Index funds are the backbone of most financial plans for a reason. They work, they're proven, and they require almost nothing from you. If you're not maxing out your retirement accounts first, start there. Choose real estate if you have sufficient capital for a down payment and emergency reserves. You understand your local market deeply. You're comfortable with the management responsibilities, or can afford professional management. You're looking for cash flow and income today, not just long-term growth. You want to use leverage to accelerate wealth building. Real estate can be an extraordinary wealth generator, but it rewards those who treat it like a business, not a hobby. The best answer for most people? Both. There's a reason the wealthiest individuals in the world rarely put all their eggs in one basket. A diversified portfolio might look like this. Max out your 401k and Roth IRA with index funds, build a cash emergency fund, and then, when you have the capital and knowledge, add one rental property to your portfolio. Over time, reinvest, repeat, and scale. The index funds give you liquidity, diversification, and tax-sheltered compounding. The real estate gives you cash flow, leverage, and inflation protection. Together, they complement each other's weaknesses. Here's the thing nobody tells you about building wealth. The best investment is the one you actually stick with. A mediocre investment strategy that you follow consistently for 30 years will beat a brilliant strategy that you abandon when things get hard. Whether it's index funds, real estate, or both, commit to it. Educate yourself, play the long game, and resist the urge to overcomplicate things. The question isn't really index funds versus real estate. The real question is, are you investing at all? Because the cost of doing nothing, of waiting for the perfect moment, the perfect strategy, the perfect market, is far greater than any mistake you'll make by starting imperfectly today. So take the first step. Open that brokerage account. Start learning your local real estate market. Put something to work. Your future self will thank you. Thanks for watching. And if this helped you think more clearly about your financial future, share it with someone who needs to hear it.